All right, good morning, everyone. Let me know if you can hear me. Adam, Alfredo, Angelo, B, Bill. All right, very good. Glad everyone could make it. We'll be starting in just a minute or two. I want to show you a few exciting things. I think you guys are really going to like the webinar. I'm going to show you some Atlas line trades, some trade scalper trades, but more importantly, I want to teach you a few things about how to prepare. The room is just about full here, so for those of you who may leave the room and then come back, you may not be able to get in. There's a capacity limit. My name is John Paul, so I'm the founder of DayTradeToWin, and the purpose of all the videos and everything that you see that I provide is to teach you about day trading without using any type of conventional indicators. So my goal is really to show you not to think about all of these indicators that you see here, right? All of these indicators. But my goal is really to show you how you can understand what you're seeing without making it overly complicated. So price action is where my foundation becomes. And we just had a mentorship class begin. Class is packed, and I'm very grateful for those of you who wanted to join and learn, because I'm actually learning as well from the experiences of many of you. So for me, this is a great opportunity to show you and to teach you. And if you have any questions, you can email me. I also provide NinjaTrader. If you need NinjaTrader, you can email me, and my staff can help you get it set up. We do remote support. So to begin here, the market that I like to trade and I focus on is the E-mini S&P, which it just started. Now, it doesn't mean you can't trade other markets. It's just that I prefer the E-mini because it's very specific on what and how the market trades. So if you're looking at crude oil, and if you're looking at the euro, and if you're looking at all these other markets, you have to think about who is trading them. So for example, I have here on the E-mini S&P the trade scalper, and this trade scalper method, something that I offer, is based off of price action, and it works, as you can see, pretty well. But beyond just looking at the signals, we also have to understand how to manage these trades, if the trade is going to be worth taking. And so there's an extra step that you definitely have to do. It's not just follow software and get me in or jump me in. It's why am I doing what I'm doing? So if there's news, as you know, I recommend don't trade during a news event because it's an unpredictable situation. And if you haven't already downloaded or viewed the videos that I have on YouTube or on DayTradeToWin.com, where I actually show you and teach you the trading the news method and the ABC method, which I'm going to do today, you can understand why and how it's important to focus on price action instead of just indicators or moving averages or trend lines or Kepler channels or Bollinger Bands or MACD. All those things can be optimized and look great, but if you're just focusing on price, the price is never going to lie to you or fail you or be optimized. It is what it is. The same thing here if I bring up a euro, for example, or crude oil. Let me see if I can find. I have multiple charts here, so I'm trying to get them all here in order. So here is a NASDAQ chart. I mean, there's a specific reason why I want to go short. It's not just because of a moving average or an MACD. It has to be based off of just price action. All right, now we're going into a cycle now as the elections approach that is going to bring some crazy volatility. We've seen very slow movement, and as you know, we can't trade when it's slow. Remember this little tool that I have on every chart down here, this guy right here, is something that's totally overlooked. And for new traders, or for those of you who already have the Atlas line or the trade scalper, you know how important this is. Because if I am about to take a trade, is it slow or is it fast or is it worth it? And if you don't know that initial step, should I even be taking the trade based on the market conditions, then you're already at a loss. So definitely understand where the market is at, and if it's slow, you have to approach it differently. If it's faster, you have to also think of it as higher risk and approach it differently. So when I look at the market, please add something that at least tells you where are we at. And this ATR, the average true range, helps me understand what the market is going to do in the very immediate future. So you can see on this E-mini chart here, it's 5 minutes here on the time frame, and it's about 1.5 on the ATR, which is the equivalent of 6 ticks. On a euro, a 5-minute chart, this is telling me 7 ticks. So you can see that there's a difference between looking at this scale at 7 ticks and this is 6 ticks, because the scaling is in points as opposed to pips or ticks. So I know that on the euro, a trade would give me 7 ticks of profit. On the E-mini, just 6 ticks. So it's not equivalent. Also, when the market is too slow, you probably know this already, but 1 point or 4 ticks on a 5-minute chart. When it's too volatile, it would be the equivalent of 5 points, or roughly 4 3/4. This is a good relative way to say this is normal. Anything above or below, they're extremes. So when you have the market being this slow under 1 point, think of it as chop, as whipsaw, as channeling. You can't really trade under those conditions. You're going to get chopped up, and you're going to sustain just constant losses back and forth and back and forth. So instead, before you enter, keep an eye on this ATR and know, okay, this is where I'm at, this is what I can expect, and here I'm going to take a nice little trade with an expectation. Now obviously every trade is not going to be a winning trade, so minimizing your losses and managing the trade is so important, because if you're looking at a 10-point loss and a 1-point target, I think we can all agree this isn't going to work. When I look at this market, first things first, understand the conditions. Second thing, look at the news. Do we have news that may affect what we're doing? Because if I'm about to go long immediately, right now, just jumping in, and then all of a sudden some type of news occurs, what may happen is the market could absolutely just spike and take me out. So my recommendation is always to bring up some type of calendar. I have here the Econo News calendar, and these red stars and red flags or red text, FOMC, very important. Now one very specific news event that sometimes doesn't mention a red text or red star or high priority is when Janet Yellen, the Fed chair, speaks, because when she does speak, everybody listens and everybody reacts. So if you ever see here in an economic calendar some type of indication that Janet Yellen is speaking or the Fed chair is speaking, it's usually at 10 o'clock Eastern or 2 o'clock p.m., 1400 Eastern. You know that it's an equivalent of being a high priority news event. So just wait, give it 5 minutes, see if there's a reaction. If there's no reaction, that means you can trade. If there's a reaction, give it 5-10 minutes for everybody to get that out of their system, for the market to get back to normal levels, and now you can continue trading. But jumping into an unknown, chaotic environment, I think that is just putting yourselves into a risk that you shouldn't be taking. All right. Angelo says here, to take a trade, the ATR should be a minute off. Now, the ATR only, Angelo, only calculates at the close of a candle. So if you're looking at here this ATR at 1.82, it's based not off the current candle that's trading, it's based off the last 4 completed candles, like so. When this candle closes in about a minute and a half, then it'll be pushed forward and that new calculation will show on the ATR. Now in addition, this ATR does not change dramatically from candle to candle, and that's a good thing, because if I know currently that 7 ticks or 1 3/4 of a point is the expectation, and the same thing here in the euro, if it's 6 ticks, now it's 0.000693. And for those of you who don't know, pips and ticks, same thing, smallest increment a market could move, and moving the decimal place 4 places to the right is the purpose of understanding the ATR on a currency. So you move the decimal place over 4 places, 6.93, I round down 6 ticks. So the ATR doesn't change dramatically from candle to candle. it can change a tick up or a tick down. And that's good because you still have a good reference of what the market is doing. You're not going to see the euro move from 6 or 7 ticks, right? It was 7 ticks, I think, the prior candle, right? 7 ticks. And now it's 6 ticks. You're not going to see that go from 6 or 7 ticks to, let's say, 3 ticks, or let's say 10 ticks or pips. You're instead going to see it move gradually up or down. Now, the reason why I mentioned that, you're in a trade, you have an expectation of a profit target based off of this ATR, 6 or 7 ticks, and now the market begins to slow down. Maybe it's contracting, maybe the candles are getting smaller because it's drying up. Wouldn't that tell you, based on the price action, that you should also adapt and change? Your target should now be consistent, or at least more conservative, because things are slowing down. It's an instant indication that you should be adapting and managing your trade based on price action, based on what the candles are doing. So I'm not using any type of moving averages or any indicators that are really going to confuse me into taking a trade or over analyzation. All I'm referencing is I can expect 6 ticks, and if the market goes down to 5 ticks and then to 4 ticks or to 3 ticks, if my profit target is, let's say it's a long trade, it's up here, then I have to slowly adjust my target because I know that this here is the indication of what it can do. So if it can't do 6 or 7 ticks, why am I going to just wait until I get stopped out? Or why am I going to be hopeful that it's eventually going to make that profit? It's not going to happen. I'd rather get out of a trade with a smaller profit and bank it, put it in my pocket and shut it down, as opposed to hanging on for 3 or 4 hours in hopes that it's eventually going to come back, eventually something's going to happen. Look at the tape and look at the orders on the dome. It's got to happen. You have to forget about all that. This, what you're seeing here, is set in stone. Do you know what's not set in stone? This is not set in stone. Let me show you. These orders here are not set in stone. What you see here are called phantom orders. And if you think that these orders are actually waiting to be filled, you're gravely mistaken. Because how easy is it for someone with a large account to put 30 or 40 contracts in any of these columns, sell or buy, and as soon as the market reaches that area, it's taken away, it's canceled, or it's moved. So if I place an order here and I wanted to get this price, and then I change my mind and I change this instead to this or to this, it just takes half a second to change it. So replace this number, which is 1, with 100. Someone who places 100 contracts, and it even could be a machine where they have this electronically looking for the disparity, the difference between NASDAQ, Russell, Dow, and E-mini, and if there's a divergence there, it puts on, takes off, puts on, takes off. And what you're seeing here is these numbers constantly changing according to that algorithm. And I can't trust that these are actual, real values, contracts waiting to be filled definitively. Maybe 30 years ago, tape readers could analyze this and say, yeah, there's a lot of support or there's a lot of resistance at any of these values, but it doesn't work that way anymore. So tape reading is gone. We can't look at this and think this is actually 1,200 contracts. If you're looking at a place to put a stop and you see big numbers and you're thinking, there's no way the market's going to absorb that and go through it, you can understand why that's luring you to think that, and then as soon as it comes close, it's gone, it disappears. The number gets down to 300 or 400. So those are called phantom orders. Don't trust them. If you're trying to look at the dome or the tape or these values on the price ladder or the matrix, right, depending on the platform you're looking at, that doesn't work that way. Okay, let me go back here. So if you're interested in a calendar, a news calendar, I offer actually 2 free news calendars, and the 2 free news calendars can be downloaded from DayTradeToWin. And for example, here, if you go to DayTradeToWin, and here is software, there's free downloads. You can download the news indicator for NinjaTrader 7, and you can download or look at the online news calendar as well. It's a web page. It's free, and that way you know when to stay out of the market when there's going to be some turmoil. Okay. All right, you got it, Angelo. Mohammed, does the ATR available on Ninja platform? Yeah, Mohammed, the ATR is available. It's free. It's part of almost every single charting platform. So if you come here and you go to right-click indicators and you look at the indicators that are listed, one of them should be ATR. The only thing you have to change is the value, because when you first bring it up, the value is defaulted to 14. I think 14 candles, 14 minutes, 14 time elements is too long to dictate what's going to happen. I use 4 or 5. I think that's a good relationship to what to expect into the future. Okay, and if you need help with downloading the NinjaTrader platform, we do offer that as a service to download it for you, and we also provide the live data, so you don't have to rush to pay for that or to get a broker. We offer the live data as well, no charge. Okay. And Angelo, you got it. Not at all, HD. The ATR is actually a forward-leading indicator. It's a forward-leading indicator, and it's not lagging at all. So remember I mentioned to you that here, if you were about to take a trade at this point, long or short, right? The ATR is telling me here roughly 2 points, 1 3/4 of a point, 8 ticks, 7 ticks is my forecast. So think about a stop. Are you going to risk 10 points if the ATR is only at 2, or are you going to risk only 1 point or 3 ticks on a scale of 2 points? So I have very clearly defined what my target is and what my stop should or shouldn't be. The next candle is now still 2 points. It's 2 1/4. Maybe it changed by about a tick, but it's only a small change. We're not looking at this lagging feature that, oh no, everything has changed. It's still 2 points. Any way you look at it, that's still the target, and the stop is relative to that. And the next candle, when it closes, you're going to see that it's going to remain at 2 points. So actually this ATR is a leading indication of what you should expect into the future, instead of being, looking at already plotted and then historical or optimized value. Not at all. Okay. Ticks and pips, same thing, smallest increment. Usually pips, you're looking at a currency, right? Forex or cash Forex, but relative, it's the smallest increment. So if you look at the dome or the price ladder, it's the smallest increment on any market is called a tick or a pip for currencies. And basically, you have to use a universal term when it comes to looking at identifying some type of movement. And that would be, bring up my, there it is. So whether this was the Dow Jones, a stock, a NASDAQ, the euro currency, the Australian dollar, the British pound, it doesn't matter. This would be 1 tick up or 1 tick down. It's just what is the value of that tick. So in the E-mini, it's $12.50, a tick up or tick down. If you look at a different market like the British pound, this is the Forex British pound, but 6B is the futures British pound. 1 tick or 1 pip is still up or down the same thing. The only difference is the British pound is worth $6.25, a tick up or a tick down, as opposed to the E-mini, which is worth $12.50. And so the tick example and the pip example is the same, smallest increment. It's the value that moves. And other markets may be more, other markets may be less. Some work in cents, but it's still referred to as a tick or pip. No, not at all. You have to have, George, with the ATR, it doesn't really matter where you put it. It'll just be plotted immediately based off the last 4 candles. So, for example, if you look at hold on a second here. I just heard the Atlas line. And okay, so let me just remove the chart. Okay, this here is the Atlas line. So to answer your question, this here is the last 4 bars, and it's still 2 points, right? So if you're looking at knowing, I guess I forgot who asked that question. If you're looking at understanding, what can I expect for the last 5 or 10 minutes, I've already realized it's 2 points. It's 2 points, 2 1/4, 1 3/4 if you want to be conservative. Regardless, this is my expectation moving forward, 2 points. Now, if you look at the 5-minute chart, it's going to be very, very different than a 1-minute chart, right? Because if you look at a 1-minute chart, you're not looking at 4 5-minute candles, you're looking at 4 1-minute candles. So here I have the E-mini with the Trade Scalper, another scalping method or a scalping method that I provide, and you can see that the difference is instead the last 4 1-minute candles is 3 ticks. Now, if you're a scalper and you want to take 5 ticks, you can't make 5 ticks because the ATR is telling you 3. If you're looking at the average true range, maybe when the market's a little bit slower, so let's take a look when it's a little bit slower here. Do you see how the ATR tells me that this is only 1 tick? That means my expectation on this long 2177 is just 1 tick, which I think is slow, too slow. But for some scalp traders, they don't mind making a tick or two. So you always have a predetermined value, knowing what to do, how much to take. This trade, remember, I don't know the future. 1 tick is all I can expect. On this trade here, it's not 1 tick. It's 2 ticks, half a point. So there's a definite difference in knowing when and how and where you take the trades. The same thing with this here. This is 1 tick. If I was going to go short, it's just 1 tick. So this is really important. You don't know how important this is because knowing something or knowing, I would say, enough about the move to help you take a profit is better than going in blind. Okay? So that is very, very important. I don't look at the average daily range, D, right? I don't look at the average daily range. Okay? I may look at other things on a larger scale, but I don't really look at the average daily range unless I'm going more for a swing trade or for a position trade, which you can. And it works the same way. So if I put up a daily chart or 60-minute chart, listen, price action is price action. We're not looking at reinventing the wheel. We're looking at realizing currently the conditions are 10 points because on average the last 4 days 10 points. If you wanted to hold on to a trade, you can't expect it to move 30 points. It's just 10 points up, 10 points down. The same thing with if you looked at a different market, let's say the euro or the crude oil, it works the same exact way. So at least understand that here is my expectation on the crude. And it hasn't changed. The last couple of days, it's all been the same. See that? Has not changed. Has been exactly the same. Very, very important. Okay? All right. Any questions here? Martin, for a day trader, 5 minutes is, in my opinion, the best. Because if you look at here, what most traders are trading, I mean, honestly, everyone here in the room, is anybody using a 7-minute chart or a 23-minute chart? Or are you using a reference of 3 minutes, 5 minutes, 10, 15, 30, 60 daily? These are all divisible by 5. What that means is if a move is going to happen, a breakout, a retracement, something is going to happen, it should happen on one of these time frames, which as a 5-minute day trader, you can catch it. So you can divide 5 minutes or 5-minute chart or 5-minute time frame into any of these, right? So it doesn't really matter if the breakout happens on a 15-minute chart. As a day trader, you have a 5-minute chart and you see it and you catch it. So that's why the 5-minute chart, in my opinion, is the best, because I would say 99% of the world is looking at one of these time frames as opposed to a 17.5-minute chart, right? So that's why the 5-minute chart is the best for me. And this is the crude oil. Let me go to back to the E-mini. And Efron, you had another question, Efron? Also, you're trading a 1-minute chart. Should you be using a 4-period ATR setting, a 20 setting, or a 20 period? No. It's a 1-minute chart. If you're looking at a scalping, Efron, it's a ATR of 4 regardless of the time frame. I may have answered this already. So it's an average true range of 4 regardless of the time frame. If you're scalping, then I could expect, so let me bring back the scalping here. If you're looking at scalping the markets, then it's the same thing, ATR of 4, last 4 candles, I can expect 3 ticks. So it hasn't changed. You see how this is still 3 ticks, this is 3 ticks, this is 3 ticks, this is 3 ticks, this is 3 ticks. Hasn't changed. As opposed to look at earlier in the day, before the market opens, where the equivalent is 1 tick, 1 tick, 2 ticks, 2 ticks, 1 tick, right? 2 ticks. So the ATR stays the same. The time doesn't matter because you're taking a trade based on that time frame. Okay, Efron? Let me know if you have any other questions. Sunny says here, do I use any candle interpretation for signals or filter? Do you just prefer their appearance? I don't use candlestick interpretation, Japanese candlestick interpretation. So you may be aware of the shooting stars. Those type of trades are a little bit subject to interpretation based off the time frame. Not to say that Japanese candlestick interpretation isn't important. I don't use it. I only focus maybe on a doji, right? I think everybody should know a doji is an indecisive candle, right? But as far as that's what I teach, I don't teach that. What I want to teach and what I want to show you instead is, why are the candles doing what they're doing? Why are they going down? Why are they going up? There has to be a reason. Usually buyers overpower sellers, sellers overpower buyers. And if I can understand that's happening, great. Now the next step, how do I manage the trade? What's my profit? What's my stop? I need to know enough about what's happening to guide me. Now, when I look at, I'll give you another example. When I look at yo-yo bars, there may be an interpretation of Japanese candlestick that says this is also a yo-yo bar. But for me, it's more important to see these candles with wicks here that tell me something is happening. So when I look at wicks, I think if the trend is down and down and down, and I start seeing wicks that, and I think one wick is irrelevant, right? I think everybody can agree there's a candle with a wick every other bar. But when you see a grouping of candles with wicks, it's not to say that the market's going to reverse, but remember, here we go with price action. Price action is telling me something internally is changing. Pay attention, because if the buyers are about to step in, maybe this market, whatever market it happens to be, is beginning to fail, I can see it with the price action. I don't have to use anything else. And the wicks tell me market tries and fails, market tries and fails, market tries and fails. And what you're left with is a wick. So it's not one wick or one yo-yo bar here and there that's going to be anything specific. It's a grouping of yo-yo bars. So for example, here, this is yesterday on the Atlas line, right? And if I'm thinking about what I just mentioned, the wicks, you can see that the market is trying to go lower multiple times and failing multiple times, as if it's trying but failing. Pay attention to that. That's price action telling you something's changing. One wick like this, meaningless. But when you have a grouping, I would say 3 or 4, that is much more important. So I'm looking at interpreting what the candles are doing to help me understand how to process the next trade. So you see how we have these strength trades and pullback trades. I mean, all these things are telling you long, but if the market's not breaking through and it tries, and the candle tries and fails, so you're left with that, and the next candle tries and fails, and you're left with that, and it tries and fails. And I mean, how many times is it going to try and fail before it eventually fails, right? So this type of idea of price action, I teach in the Power Price Action course, is very important. And I like to, excuse me, I like to bring this out to traders, because it's not just following a moving average cross or a momentum or a MACD. There's so much more that's involved. Another example I can give you, this is the day before in the Atlas line. So for example, here you have, all these longs, right? Long, and then all of a sudden the market reaches a point and it tries to go higher in this trend and fails, tries a second time, tries a second time, a third time, a fourth time. Something is happening. And again, it's not to say it's not going to move higher in the future, but if I'm about to tighten up a trailing stop, if I'm about to think about taking a profit, am I really going to wait for it to hit here, knowing that it's trying and failing multiple times? The ATR is going down, right? So it started off at 3 points. Now it's only 2 3/4. Now it's 2.5. Remember, it only changes a tick or two at a time. I would say to you, listen, you initially wanted 3 points on a trade. Now you can only get 2 3/4 or 2.5, which is 10 ticks, 11 ticks respectively. Take the money and run. Look at what's happening. Pay attention. So I'm not using any special optimized indicator to tell me this. It is what it is, right? Let me take a look at some questions here. I only stay in the trade for a few bars, right? So one of the methods that I teach everyone is what's called time-based stop. If you enter a trade and it doesn't make an instant profit, right, HD? Does that mean that eventually it's going to make it, or does that mean that for the reason that I want to take a trade isn't happening? Whatever reason I went long or short, it's not happening. So if it doesn't happen within the next few bars, then why am I going to hold on to it in an hour? In an hour, it's probably moving on something different. So a time-based criteria, a time-based stop, some type of time element is important as far as trade management. So all these things that I'm referring to, trade management, you have to have multiple types of stops. The proof that the market is failing and not continuing, very important. So all of these things that I'm showing you have to be looked at as a combined idea that the market is or isn't doing what you want. And I rather take a smaller profit. I rather take a trade that is going to give me a break even. What I don't want are large losses. Okay? That is very, very important. So all of these methods that you're seeing, you start off with a tool, and if that tool gives you a trade, the next step is, what's my risk? Should I take the trade? Here's an example of a trade down here. This is a short on the Atlas line, looks on August 16th. And I have some recent trades which are going to be updated shortly, which will bring this current, the report there of the Atlas line trades. So this is a trade here to go short at 21.79 here, right here. So that's set in stone. That's the Atlas line trade. And the next step, what's my profit? What's my risk? How do I manage the trade? All these things that you may be wondering. So it's not just look at the signal and jump in. It's look at the signal and ask yourself, why am I taking this? And should I even be taking it based on, is there news? Okay, so one of the things we all don't look at is overbought, oversold, overexhausted. This idea that I'm the last guy going short. Nobody ever thinks about that. I teach that. I want you to know that even though this may be a short trade, how far away are we from the Atlas line, which would make it oversold or overexhausted, which would in turn would not give me a profitable trade? Well, the distance between here and here has to be calculated. And if this distance is anywhere near being oversold, skip the trade. Because you're the last guy going short. Everybody else is now maybe going long or taking profit. Why risk it? If this trade short was closer, let's say it was just about a tick or not a tick, but 3 ticks, 4 ticks, a point, it's a different story. We're entering long or short at the beginning of the move down or the beginning of the move up. But entering short on this trade with the respect of being almost 3 points away, I think it's a riskier move. So overbought, oversold is a crucial part of what I teach, because it's not just a signal. It's what's my profit target, what's my stop, what's the risk, is it overbought, is it oversold? And I'm not using any fancy indicators to help me understand that. I'm just using numbers and the price. I'm using wicks. I'm using the candle's closing price to tell me how to approach it. So I get this email all the time. Do you have a trading room? A room where I sit there and I pull off trades. I don't think anybody learns anything from sitting down and following somebody, because you're going to follow somebody and you're never going to learn how to do it yourself. I want everyone to be independent. I want everyone to wake up, look at the chart and say, no, that's not a good trade, or yes, this is a good trade, right? So if I was going to take this trade short here, 21.80.50, this is a much better trade. Look how close you are to the Atlas line as opposed to down here. It's night and day. It's not just, why are you doing that? Oh, I can't tell you because, you shouldn't know that. Just follow the trades. Know that this is an overbought, oversold condition. Another thing that I look at is this candle right here. This candle right here, if I took the Atlas line off the chart, you would say, I don't know what it is. What is that candle? That candle is a bounce candle. That candle is bouncing short or bouncing down. Now, you can look at the chart and say, well, I can't see it. But let me put on the Atlas line, and it's going to be crystal clear. This candle opened here, ran up, hit the Atlas line, and then bounced back down. Not only did it bounce back down below the Atlas line, it overtook its opening price. It's a lower close than open. This indicates that the sellers are in control after hitting some type of resistance. The Atlas line is not a moving average. It's not a trend line. It's a support and resistance calculation. It's nothing to do with optimization. As a matter of fact, the best thing about it is there's no values to optimize. The only value you have to stick in is, when does the market open? The market opens at 9:30. It has a sound. You can make there's a filter here when the market's too slow. And it gives you the pullback and strength trades, and you can turn all this on or off. But it's not something that is so optimized where you have to just look at specific values and specific numbers. And in addition, if you look at the Atlas line where it's trading, right, where you see it trading, if you put on a 1-minute chart, right, everybody sees where the Atlas line is. You put a 1-minute chart, and I think that was the 16th, right, that we were looking at. So let me go back to the 16th here. It's exactly the same Atlas line plot. So this does not change based off of the time. It's not optimized based off the chart. It's based off of support and resistance. Okay? So it doesn't matter the time frame, even though 5 minutes I think works best, as well as 15 minutes. The angle of the Atlas line, where it plots, doesn't change. What changes are the candles, the price action. And that's where we then take the next step. So you have here an overwhelming short, right? These are all shorts. These are all shorts. If I put up a trade scalper, which is scalping signals, the trade scalper method, the trade scalper software, which is the software is right here. wouldn't that indicate that, and it's hard to see, but wouldn't it indicate that the trades that you should be taking are short as opposed to the trades that you're taking long? So for me, if I have the trade scalper and I have the Atlas line, I'm not going to focus on long trades. I'm going to focus solely on short. So what you see here is a trade scalper short. You see here a trade scalper short. This is a double bar short for the Atlas line. I'm not going to take long trades until what happens? Price goes above the Atlas line. Now you're scalping for long trades only. Now it falls below. Same thing, falls crosses above, long. So this short, double wick short here, is above the Atlas line. Therefore, you don't take it. Focus on longs. So there's definitely this idea of why am I using price action to trade? This is it. Okay, so let me actually turn all this stuff off here. Actually, I want to show you and teach you something today. I want to show you how to divide up the day, how you can tell a trend. You know, the purpose here is to show you a couple of my things, the methods, and teach you, but something you can take away from. So what I'm going to do is I'm going to remove here everything off the chart.